This video is how to trade on Phemex exchange. We're going to go through inputting orders into this trading system and then everything else you need to know, both in the spot market and in the futures market and the differences here. Now, if you are a beginner or new to Phemex, check out mock trading as well. So click that and it will take you to this page, which is the real, trading system, but with paper money. So you can, use this, trade and see if you make any mistakes or anything like that, but obviously not take any risk with your actual funds. You can click this icon right here and it will basically give you some paper money to trade with. And then you can go ahead and, see how the system works for you. We'll click over to the spot market first though, so we can trade in the spot market, actually buying and selling cryptocurrencies. Also, if you are new to Phemex, they actually give, I think, some deposit bonuses or other sorts of incentives for new users. I'll leave the link below. You can check the details at the time you're watching this if there's any deals running at the time that you sign up for an account. We'll start off with the spot trading platform then. And spot trading just means cash settling the assets that we're trading. So we are going ahead, we are spending some value and we're getting the crypto. We own that crypto and we can do whatever we want with it. We can take it off the platform if we want, or we can just leave it on the platform. So every crypto asset trades in a currency pair, right? So if you want to buy Bitcoin, you have to sell something else. So we're going to click BTC USDT here. That brings up all of the currency pairs, as you can see. So as you can see here, USDT, most cryptos will trade against dollars, essentially. USDT and USDC, these are stable coins valued at $1. So we're essentially trading Bitcoin against the dollar. But of course, this is crypto, so we need a crypto dollar, essentially. So Bitcoin against USDT, you can see all of the other trading pairs right here. If you want to use USDC, you can do. There's trading pairs right here as well. Most people will use USDT, and I think the support is a little bit better for USDT on Phemex platform. There's also one fiat currency list as well, which is TRY. So if you're in Turkey, you can use Turkish lira to swap into these three assets. If not, then obviously you can't use it. There's one BTC pairing as well. So that's Ethereum valued in BTC. We'll click on Bitcoin valued in dollars though, as this is what most people want to trade. So if you click that, it takes you through to the market of this currency pair. So we have the currency pair chart. We have the price of the currency pair trading. So what this means is essentially how many dollars does it take to buy 1 unit of Bitcoin. So this is Bitcoin, the base currency, valued in the quote currency USDT. How many dollars does it take to buy 1 Bitcoin? At the moment, as of making this video, 66,000. And we can buy any fraction of a Bitcoin. So we don't have to spend 66,000. So that's where we get the price from. Now, if you're just using Phemex to go ahead and buy Bitcoin, and that's all you want to do, then of course, how do you get fiat currency in to do that? I've got a beginner's guide that goes through, setting up on Phemex. I'll link it below. But essentially, you just make a deposit via either a bank transfer, or you can use credit and debit cards to buy the crypto assets. You can see that here, so you can screenshot this. All the major currencies are supported right here, as you can see, although the support may change depending on which region you're in. And fiat currency transfers will have a fee, as you can see here, when switching into a cryptocurrency. If you just want to buy Bitcoin, right, so you can actually just switch the fiat currency directly into Bitcoin, right? Because you don't want to go from a fiat currency into a dollar stablecoin and then into Bitcoin. You just want to go straight into the crypto and cut out as many steps as possible. So here is the buy sell feature. It's quick buy sell. If you have a fiat currency balance, or if you want to go ahead and buy with a fiat currency that's supported, you can click that here. So I'll show you an example with euros, and then which crypto do you want to receive. So if you just want to trade around, or if you want to trade futures, you do need the stable coin. So go ahead and swap your fiat currency into a stable coin. If you're just looking to buy Bitcoin and you want to hold it and you want to cash settle it, then just directly buy BTC here. And you might get lower fees because then you don't have to switch into Tether first and then go ahead and trade it for Bitcoin. So cut out as many steps and fees as possible, obviously, just to make things as cheap as possible. But you can see some of the costs for swapping fiat into crypto and some of the options here. It's going to change in your region. You can see them here: SEPA, bank transfer, Visa, MasterCard as well. Like I said, beginner's guide tutorial below, but hopefully that explains getting fiat currency in and out and making sure that you buy the cryptos that you want with the least amount of steps. Now I'll show you how to trade on the spot trading system if you do have stable coins that you want to swap into a crypto, or if you want to sell the crypto back into a stable coin, you can do that here. So make sure that you have the currency pair on the left-hand side that you want to trade, and that will bring up the price right here. So if I click a different currency pair, you can see that the price changes. And of course the market changes. because this is a different market with a different currency pair. So we're going to go back to BTC, and this is the price right here. So if you want a more in-depth video on technical analysis and charting and what the charts mean, I'll leave some videos below that go through that. But this is essentially the chart of Bitcoin valued in dollars over time. And obviously very clearly we're in an uptrend here, as you can see. So on the right-hand side, we have some details that are important to know about. So this is known as the order book because this is where everyone places their orders. And so it used to be a physical book, and now it's obviously a digital screen. Now, the green items down here, these are buyers, known as bids. So when a buyer shows the market their bid, it comes onto the screen. And it's in green, they are buyers. You can change around the colors here if you want, but most of the time it's green and red, certainly in the Western world. So green and red, green buyers, red sellers. These buyers down here are showing their bids, and they're obviously below the current trading price. That's why they're below the mid price. This mid price here is the price where buyers and sellers are actually meeting and trading. Anything above this, these are sellers, and these are a little bit expensive compared to the current price. So you can see them here, right? So if we go up to this one, this is 66,200. So he wants to sell a Bitcoin at 66,200. The current market price is 66,100. These guys want to buy, and they're down at 66,000. So you can see the difference there. Of course, in the middle, that's when buyers and sellers actually meet and go ahead and trade. When the price changes green, that means that a buyer has come in and lifted the best offer. So these are known as offers, or if you're in the States, these are known as asks or the ask, right? And you can see this right here, 142. So what's happened is a buyer has come in and was willing to pay 142, 66, 142. And that's green because obviously a buyer has paid that higher price. If someone comes in as a seller and sells at this lower price here, then that's obviously a sell order, and the price will flash and it will be red, knowing that someone, the last trade, was a seller who actually took the lower price. In any case, we just need to know that this is the mid price, and we can put our orders in around that as we want. So that's the order book, and that is how pricing works. On the right hand side, we have buy sell like this, and we have lots of different order types that we can put in. The two main different order types are limit order and market order. So these just let us enter our orders in the way that we see fit. A market order is where you tell the system you want to immediately buy a certain amount of the crypto, and it's going to go out and it's going to trade that crypto at the best possible price at the current time. So the only thing we choose is how much of the crypto that we want to buy. So we're buying BTC, right? Because it's Bitcoin against USDT. And I have a balance of USDT right here, as you can see. That's in my account. You can transfer. So if you want to press transfer here, you want to transfer it between your accounts, you can do that right here. But I've got a balance of USDT, and it tells me how much I have. So what I can tell the system is, I want to buy an amount of Bitcoin, and it's valued in dollars. You can also change that to BTC. So if you know exactly how much BTC that you want to buy, right, 0.01, you can do that here. But you don't really know what the amount you're going to spend is, because you don't know what price you're going to trade at. So just keep it in dollars. I want to buy this amount of dollars, right? So how much BTC am I going to get? It can't tell me exactly because this price is changing, as you can see. And all I'm telling it is I want to buy $15 worth. So what I'm going to do is press buy BTC here. It's going to check with me. I press confirm, right? And that will go through and that will trade, pretty much instantly. What we're doing here, as you can see, that's traded. What we're doing here is just telling the system, just buy at the best possible price at the current time. Now that's very different than a limit order, as we'll see here. So if I go over to limit, you can see this will change on the right-hand side, and I get another box. Right now I get two boxes. A limit order is where you're telling the system exactly how much you want to buy, and also the exact price that you want to pay. So what we're going to do is put a price in here. So the current price is 66,116. So let's put 66,105. So what I'm telling the system is I'm happy to buy the exact same amount of BTC here, but the most I'm willing to pay is 66,105. Now the current price is 66,135. So we're a bit cheap, right? And we're not going to get our order filled right away because other buyers are above us willing to pay more than us. But this is our limit, right? It's our limit order. So this is telling the system, I'll put my order in. You can work that order for me. You can have that order in the system. If the price gets down to my limit or better, you have my permission to go ahead and trade and put that buy order in. So we're going to do exactly the same thing. We're going to buy $15. This is our limit price. So we're going to press buy. We'll confirm. And what you can see is that this should come down here, but it won't trade. Unlike the market order, which just goes and trades at the best price available, any price, this won't trade unless the market actually comes down to our price. So you can see down here, I've got a buy order. This is the amount. This is my limit price here. And of course, it can exactly work out because it's the price times the amount that I'm trying to buy. It can exactly work out how much Bitcoin that I would get from this order. Right, you can see the price is starting to come down as well. So we may actually get this filled. So that's a limit order. It's in the system and it's good till cancelled, meaning that limit order is just going to stay there until you physically cancel it in the system. And if there's a seller willing to sell to us at 66,105, then we'll go ahead and trade. If not, then we won't get our order done. This just lets us be a lot more specific with the price that we're trading at. Also, you can see the price does move around a lot. And so a tip here is we're actually at the top of the order book. You can see that right here, right? That's our blue icon right here. So we're at the top of the order book. So if there's sellers coming in, we may actually get filled. So this just lets us be more specific with the price. And also a tip is when you're looking to buy BTC, just put a limit order in a little bit below the mid price. You can see the price moves around a lot. So if you just put a limit order in a little bit below the mid price, look, it's not a big deal. It's not going to be a huge amount of money, but it does just save you a little bit. You also sometimes pay cheaper trading fees as well when you use limit orders instead of market orders. So over time, you're going to save a bit of money. It might not be a lot, but it's money nonetheless. So that's a tip to use limit orders there. Just put the limit order a little bit below and then just wait for the market to bounce around and you might get your order done. There's another order type on Phemex that we can use called conditional orders. These are putting in a limit or market order only at a given price, known as the trigger price. So when we use a market order, that goes immediately. When we input a limit order, we are saying trade immediately as long as the price is at or better than my limit. With conditionals, there's a trigger price at which you then input a limit or market order, right? So the system only inputs a limit or market order if the trigger price is met. Why would you want to do that? This is mostly used for sell orders, actually, with stop losses. So if you want a stop loss, which is, let's say you buy at 66,000, and if the price falls to 60,000, you want to take a loss. Well, you can't use a limit order there because a limit order, if you put a limit order in and you said sell at 60,000, then if the price is anything above that, it's going to sell immediately. But you don't want to do that, right? You want to wait until you're actually making a loss to then cut a loss at a lower level, if that's a stop loss, right? So conditional, what you're saying is at this trigger price, then enter the order that I want you to enter. So we'll just enter a market order here and the trigger price is 60,000. We're going to sell the BTC that we have, that we just bought, right? So that's our stop loss now. So what we're saying is if the price gets to 60,000, that's our trigger. Then enter the sell order as a market order, right? So we can't do that right now as a market order because if we sell market, we sell immediately. We can't sell in a limit order at 60,000 because we also sell immediately because the price is 66. So this conditional order, it lets us input a stop loss saying if we get to 60, then you can sell the BTC. So I can put that in right here. So the price is 60,000. This is the BTC that we've got to sell. Press sell BTC, confirm. That is now an order that I put in. And you can see that right here on the chart. So this is a conditional order and I'm selling the BTC. That lets me put in a stop loss and sell for a loss on the BTC that I just bought. So that's how we put the conditional order in. You can't use that with limit or market orders because it wouldn't have that. It would have sold already. So that's how you use conditional orders. They're mostly for stop losses. You can use them for buys as well. So if you want to buy higher, maybe on a breakout or something, most people will use them as a stop loss. And then I'm just going to cancel this out. So canceling. There you go. So that's conditional orders. Now we'll look at trading in the futures market on Phemex, or what they call contracts. You can see here. So USDT M and Coin M. These mean USDT margined and coin margined. These are known as perpetual futures or perps. You see them traded on most crypto exchanges. These are really for short-term trading or for hedging of your portfolio. So these are actually trading derivatives contracts of the cryptos that we know. So that means that we are just trading the price of the cryptos. We're trading a contract of the price of the cryptos. So we don't buy or sell any cryptocurrencies. We don't own them or sell them out. We can't take them off the platform. This is just for trading the price with other traders. So what we're doing is putting money into the contract trading platform or the futures platform. And that money there is to pay for any potential losses that we have. And of course, if we have profits, then the profits come to us as well. So we're not buying and selling cryptos. We are just trading the price of the crypto. When we open the position and when we close the position, there will be a profit or a loss. That gets put into your account or taken out of your account. And the money that you put into the futures trading account, that is there to fund any losses. So we call it collateral. That collateral is there to trade with and fund any potential losses that we have. This is just buying and selling or opening and closing and taking a profit or a loss out of that trade. This is for short-term trading or hedging, like I said. So we'll go through with some of the details here. So which one should you use, USDT margined or coin margined? USDT margined means you put USDT onto the account as your collateral. So essentially dollars. Coin margined is where you put the coin itself. So I think you can use Bitcoin and some other major coins. That is where you put the coin in and the value of that coin is used as the collateral that you have or the margin that you have. That's fine too. But of course, that collateral that you're putting in is a risk asset. And so that can go up and down in price and value, which means your collateral that's funding your positions is going up and down in value, which is more risky, of course, because you have now collateral that, you don't really know what the value is. So most people will use USDT margined because they know if they put $1,000 in, they have $1,000 of collateral, and that lets them more easily trade the positions that they have because they know how much collateral there is. They know what their potential stop loss is if they're making a loss, and so they know they have the collateral there to fund that trade. So most people will go ahead and use USDT margin. So we'll click that here, and this is the trading screen. Now that you've decided which type of collateral that you want to use and put into your contract account, we can now choose how to fund each of our trading positions. So if you want to transfer capital over, you can see assets here, press transfer. You can put any assets from your spot account into your contract. So just switch them over. And then up at the top, it says isolated or cross. You can choose them. Isolated is where each individual trade that you have has an amount of collateral that you put into that trade. And that's the collateral for that trade. Now you can pull collateral in and out, but it's siphoned off from all of the other trades. Cross is where you're using all of the collateral in your account to fund all of your positions at once. Cross margin is typically a little bit riskier because if you have one trade that goes haywire and you lose money on that, it can affect your other positions by liquidating your account. Because if you go into a loss, you're not going to go into a loss. You're going to get liquidated by the system, which means it's going to sell out your positions so that you can fund your losses that you have. So cross versus isolated. Most people will use isolated just to make sure each individual position is funded separately. And so if one position goes south, then it won't affect the others. However, you should be using stop losses in futures because this is for short-term trading. And of course, losses, you don't want to get liquidated. So each individual stop loss that you have, the order, that should protect you really. But most people will still use isolated because there's no real reason to fund all your positions unless you're doing a strategy that requires that. Now we'll look at using leverage and some of the implications of it. So what is leverage? It's where you can trade in the market, you can place a trade with an amount higher than what you're putting down into the trade. Right, so if we, for example, have 2x leverage, we can put $1,000 in, but the trade size is actually $2,000. So 2x leverage, the trade size is 2,000. We're obviously using 1,000 because we're using 2x leverage. The reason we can do that is because we have $1,000 of collateral to pay for the loss. Now, if you're using 2x leverage, what that means is you have a position size of 2,000. If that drops by 50%, then you lose $1,000. So your actual loss for the amount that you put into the trade is 100%, right? Because you lost $1,000 from a 50% move, but your $1,000 is gone. So leverage It works the other way, right? So if you have a $2,000 position and it goes up 50%, then you make $1,000, or actually from the original capital that you put in, you make 100%. So leverage makes your profits and losses bigger in relation to the amount of capital that you have down into the trade. That doesn't mean that you have to take more risk, right? Because what you can actually do is simply have $1,000 position, but only put $500 into the trade, right? You have $1,000, but you don't need to put all $1,000 in there to open the trade. You can put $500 in and open the $1,000 trade, right? And then you have that $500 there to either open other trades that you think may work, hedge trades, or just have it off the platform, right? So we don't need to use leverage to increase the risk. We can use leverage to reduce the amount of money that we have on a centralized platform, and we can use those assets elsewhere. For example, with Ethereum, if you have ETH, you may want the most amount of ETH being staked because it's earning, 3%, 4%, whatever it is, right? And so you don't have that tied up. These are small margins, to be honest, but it just shows you how leverage doesn't need to be used to just increase the amount of risk. So how do we use leverage? It's up here. You can see long, short. You can click this, and it's going to open this drop down for you. So I'm using isolated leverage, and you can see here how much leverage that you want to use. Leverage, it's not as important as the technical analysis that we do to trade with, because with futures, we need to make sure that our trade has a stop loss, because this is short-term trading, right? And this isn't investing where we can just dollar cost average over time, right? This is short-term. So we have an entry point and we have a stop loss where we take losses in the trade, and that's it. Now, from that entry point and the stop loss, we can exactly work out how much risk we're taking in the trade and how much money that we may lose. And then from there, we can work out how much leverage we want to place onto that. So you can see what I've done here. I've just drawn this box on the left-hand side. So I've just drawn, instead of a brush, I've drawn a rectangle and then drawn this on. That is, for me, a support area for the current price, right? You can see support here. Again, like I said, if you want some more detailed trading videos, I'll leave them below. But this is a support area where if you were to go long at this price here, the price is currently trading here, then you would expect, if we do come down, that this is an area where we could get to and hopefully bounce from again. If you're bullish and you're buying, you're thinking this is an area where you would hope it to bounce. Where would you place a stop loss? You would place a stop loss underneath this, because if the price keeps moving down and then down here, essentially your long trade is obviously wrong. Not wrong, but for the time, right, the time horizon you're trading, which is short term, I guess you're going long here because you're thinking maybe we're going to break out of this range, right? And so you're thinking we're going to go higher. If the price is coming down to support and going lower, then you're clearly a bit wrong with the short-term trading idea that you had. So in any case, you open at a price, and you have some stop loss price based on your analysis, your technical analysis, and where you think if the price is getting down here, I just need to get out because I got the trade wrong. Could even be up here where you think, I think we're actually just going to bounce higher, and so the stop loss price is here if I get it wrong, because I don't want to come down and take losses here. So it's up to the individual, but you need an entry price and a stop loss, and from there you can work out how much you want to put into the trade and how much leverage that you can use. Now let's look at entering an order and seeing how much risk we can take in a position. For example, if you had $1,000 trading account for day trading and risk taking, right? How much do you want to risk of that, and how much leverage can you use? So let's say that we're going to enter an order here at the current market price, which is 66,000, and we have a white line here, which is our stop loss at 57,000. So on the right hand side, I've put an order in here. So market order, we're going to open market order, and we're putting in a long of 0.001 BTC, which should be around $65 at the current price, right? $66. So let's open that. What we can see is that we're using 5x leverage, all right? 5x long, 5x short. You can change that around by clicking on this, but we're using 5x. Down here, we can actually see the calculation that it's going to cost us $13. 13 times 5, that brings us up to the total order size that we're placing in the market, but we only have to put down $13 of that. So we're getting 5x on that. That's our cost. That's how much we have to tie up in this order, and our order is bigger than that. You can also see the estimated liquidation price. So that is the price at which this $13 would essentially disappear and we made a loss in the trade. And we have no money left. And so the platform is going to liquidate us so that we don't have a bad debt. 53,000, let's call it 52,989. So 53,000. So 53,000 is here. That's good because that's below my stop loss. And that should always be the case. It should be away from the stop loss. If the liquidation price was in here, within my stop loss, I'm using too much leverage for the position because I'm saying my analysis wants to take a loss at 57,000 here, but the leverage is so high that I'm going to get liquidated before that. Well, that's obviously ridiculous. You can't trade like that, right? Because you're going to get stopped out before your own stop loss, which is crazy. So if that's the case, you're using too much leverage for your stop loss. And so you have to reduce that so that the stop loss comes away from your stop loss price, the liquidation, right? So the liquidation is away from your stop loss price. Therefore, you're fine. You're taking your loss before any leverage will get liquidated, right? So that's how we would make sure that we are trading with a stop loss where we know exactly what the stop loss is. Now, from there, we can also work out how much risk we're taking in relation to our portfolio. There are many position size calculators online, and you can just work out exactly how much risk that you want to take. So we're trading Bitcoin USD. I'll try and link this calculator below. You can put the details in. So my open price is 66, which is the current market price. My stop loss was 57, and my account balance, whatever you want it. And I'm going to risk 3% of the portfolio. You'll see online, most traders will say risk 1 to 3% of the portfolio. It's up to you. You know, if you want to risk a bit more, go ahead. If you don't want to risk as much, it's up to you. But, you know, most trades 1 to 3%, which is, you know, fine if you want to go ahead and do that. So calculate, and it's going to tell me exactly how big my order can be, right? So I can trade this amount of BTC. So that's what I'd put into the system. So I'm just doing this on, round balances here. You can do this with any amount you want. So if you have a bigger portfolio, then calculate, it's just going to move up the decimal point, right? So that's the size that you can trade. If you got in at 66 long and with a 57 stop loss, you know that if you did get stopped out, then you're risking this much, right? And to risk 3% of your portfolio in this trade, 0.03 BTC is the trade. So go back and you know that you can open a BTC trade, right, of 0.03 or 0.003, whatever it would be for you. That's the size that you can trade this order to risk that amount of your portfolio. If you had, I think it was a $10,000 portfolio. For 1,000, then you add another decimal. So we know the trade size. You can trade size BTC here. So we know the trade size. We also know the leverage that we're taking. And as long as that is away from our own stop loss, we're fine and we're not taking too much leverage. That is how to trade leverage without taking any extra risk compared to your amount that you're trading with. If you want to take extra risk, then just up the leverage, but the liquidation price is going to come up, meaning that a smaller percentage loss is going to liquidate you, right? So 2x leverage is a 50% downside move, you get liquidated. If you go up to 10x leverage, then a more or less 10% downside move is going to liquidate you. So the more leverage you use in relation to your amount of cash that you have in, the quicker you're going to get liquidated, and that's obviously more risky, right? So it's up to you how much leverage and risk you want to take, or if you don't want to take any extra risk at all while still using leverage in a clever way. If you are new to Phemex, I'll leave the link below. You can see which offers they have at the current time if you are a new user, and some other more detailed trading videos down in the description as well. I'm James, it's Money DG. Cheers for watching, and I'll see you in the next one.